Heya Cryptozens, it's 10 p.m. Pacific time. My name is Nikodemus, and welcome back to the Crypto Overnighter, where we take a nightly look at the crypto, NFT, and metaverse space. And keep in mind, nothing in this show should ever be considered financial advice. Hey folks, it's November 29th, 2022, 10 p.m. Pacific time, and here we go. We have some central bank digital currency news for you today. Now, the first story comes to us from India. The Reserve Bank of India announced a series of tests for their nation's CBDC, the digital rupee. Now, this would be their retail CBDC, and these tests will take place in 4 cities with participation by 4 banks. Now, the cities are New Delhi, Bengaluru, Bhubaneswar, and Mumbai. The plan for this next stage is to see 9 cities and 4 more banks added to the test. Now, the central bank said that testing would be among a select group of customers and merchants. Reportedly, it will be issued in the same denominations in use today, right down to the same banknotes and the same coins. Payments will be made to merchants by scanning a QR code. And we talked about this plan in October, when India's Finance Minister Nirmala Sitharaman spilled the beans about a digital rupee during her budget speech in February. Now, the digital rupee is a retail CBDC. It's expected to be used by citizens and individuals. It's not the notes exchanged by banks, although we do have a story about one of those, the Venus Initiative. Now, the Venus Initiative is the European Investment Bank's latest experiment in institutional-grade CBDCs. And so it was announced today that France and Luxembourg have managed a €100 million bond using a CBDC. Natalie Afavre is the General Director of Financial Stability and Operations at France's Central Bank. She described the Venus Initiative as showing, quote, how digital assets can be issued, distributed, and settled within the Eurozone in a single day. She also said that it shows a CBDC can be a safe financial instrument when it comes to a, quote, safe tokenized financial asset space in Europe. Now, the European Investment Bank engaged in a little snark after this. They said, quote, unlike some cryptocurrencies using blockchain technology, the EIB's blockchain bond issues do not lead to extensive energy use. They went on to say that this experiment, quote, paves the way for future on-chain derivative solutions by using the first interest rate swap hedge represented through the industry-developed common domain model. Now, Ukraine is also looking into its own CBDC. The National Bank of Ukraine sent out a press release yesterday that said that they were looking into an electronic version of Ukraine's currency. They said that they were looking into retail non-cash payments, virtual asset circulation, as well as cross-border payments. Now, this report said the CBDC would, quote, become one of the key elements of qualitative infrastructure development for the virtual assets market in Ukraine. Keep in mind, this is not a new idea for them. They've been talking about it since 2017. In July of 2021, President Zelensky signed a law that would allow the central bank to issue a CBDC that's classified as cash. And again last December, one of Ukraine's oldest commercial banks announced that they were going to test a CBDC on the Stellar network. And while the central bank said that they were working with other organizations and governments, they also said, quote, at the same time, the National Bank, like most central banks of the world, will approach the issue of issuing its own digital currency carefully and taking into account, in particular, the potential impact of its introduction on the financial system of the state. Speaking of banks, central and otherwise, how does Sam Bankman-Fried have a bank? I ask because the former CEO of FTX invested heavily in one, but not through FTX, and it's one of the stranger mysteries around FTX's collapse. Farmington State Bank is about an hour south of Spokane in Washington State, near the Washington-Idaho border. It has 30 employees, 5 of them are in Farmington, Washington, and 25 remote workers. Now, these 25 remote workers belong to Farmington State Bank, but they are also working for Moonstone Bank. We'll get to them in a minute. Now, Farmington State Bank was founded in 1887 by a cooperative of farmers and ranchers, and Farmington State Bank has been in the same building since 1911. They have no online banking. They offer no credit card. In fact, until recently, it was the 26th smallest bank in the country. And in 2010, its then president, John Wyden, said that the bank stopped offering mortgage loans because the paperwork was just too much. The bank's big thing is ag loans to farmers. That is far and away different from Moonstone Bank. Now, Moonstone is the new digital banking arm of Farmington State Bank, and it has not yet opened to the public. So what happened? Alameda Research invested a hunk of money in a company called FBH. FBH is the parent company of Farmington State Bank. At the same time, the FDIC said that Farmington State Bank had a net worth of $5.7 million. So it's a small bank, right? I guess that depends on who you ask. Because I would think the $11.5 million investment that Alameda Research made in Farmington State Bank would be viewed as significant. Apparently, that feeling is not universal. Josie Booth is the director of business operations at Farmington State Bank and Moonstone Bank. And he was interviewed at the bank when he said that the $11.5 million investment in FBH was less than 10% of the company's total value. According to frontline staff at the bank, the investment was, at least in part, to get Moonstone off the ground. Now here's where things get a little bit weird, because FTX and Alameda Research are not the only crypto connections to this tiny little bank. Gene Chapolin is the co-creator of a cartoon character by the name of Inspector Gadget. He is also the chair of FBH. Now, FBH just bought this bank a couple of years ago in 2020. But wait, there's more, because Chapolin is not just the chair of FBH. He's also the chair of Deltec Bank, located in the Bahamas. Which means that the rabbit hole goes even deeper, because one of Deltec's biggest and best-known customers is Tether. You've heard of them. $65 million firm that offers a stablecoin. Now, Tether is no stranger to controversy, in part complicated by the fact that they have offshore bank accounts. In addition to that, FTX was one of Tether's largest trading partners. Now, I don't know that there's anything to that or not. I do know that it's weird that total deposits for this small country bank went from being steady at $10 million to jump to almost 600% at $84 million. Now, according to the FDIC, most of that came from 4 new accounts. Camden Fine is a bank industry consultant, and I like how he puts it. Quote, "The fact that an offshore hedge fund that was basically a crypto firm was buying a stake in a tiny bank for multiples of its stated book value should have raised massive red flags for the FDIC, state regulators, and the Federal Reserve. It's just astonishing that all of this got approved." Now, being in fintech, it's not too surprising that SBF's involvement in banks doesn't end there, although it got tricky. Because with most banks, they're kind of reluctant to work with crypto companies. Well, that's where Alameda Research came in, because customers were wiring money to FTX through Alameda Research's bank accounts. Customers were told to send wire transfers through Alameda's accounts at the bank like Silvergate Capital, Trust Bank, and Signature Bank, among others. And that money was to go to FTX. Now, how much money are we talking about? SBF reportedly believes it's around $8 billion, which is part of the problem, right? This commingling of resources between FTX and Alameda Research. Things like FTX ensuring that Alameda Research never got liquidated. I'm not sure what they were thinking. It's a very bad idea to commingle your money and your customers' money and the counterparty funds. And at the very minimum, even if you never make a mistake, it's extremely sloppy and a horrible form of risk management. Now, what's the actual story here? SBF admitted to using Alameda's bank arrangements for FTX user deposits. That's a big deal because it indicates a degree of collusion between the exchange and the hedge fund from the very beginning. And that seems to be where the problem started. That lack of separation between FTX and Alameda Research. Now, SBF said that he never gambled FTX user funds. But you can see, in fact, that they transferred the money back to Alameda Research in the form of loans, which kind of leads us back to the beginning of FTX's crisis. You see, Sam was in an interview with Vox when he said that he thought Alameda had the collateral to cover the loans. And at one point in time, they may have. But that collateral was in FTT. Now, FTT is FTX's native token, and it went down something like 98%. And as FTT went down, so did the value of that collateral. Now, I can't say 100% that there was something illegal going on. It might very well be that using Alameda's accounts for FTX purposes is completely above board and within the rules. That's going to depend on what the arrangement was between Alameda and those banks. Speaking of Silvergate Bank, they took the time to reveal their entire exposure to BlockFi was less than $20 million. Silvergate explained that BlockFi is not acting as a custodian for Silvergate's Bitcoin collateralized loans. In fact, the bank reassured investors that they have no investments with BlockFi and has said that their loans appear to be healthy with, quote, zero losses and no forced liquidations. Alan Lane is Silvergate's CEO. He said that the bank's platform was designed to manage stress and volatility. He said, quote, the SEN continues to operate as designed, and our support teams are available 24 hours a day, 7 days a week, to help out our customers during this period of adversity. Now, this comes after rumors on Twitter that Silvergate lent money to BlockFi. Silvergate characterized that speculation as, quote, false and misleading statements. Senator Ron Wyden of Oregon is the Senate Finance Committee chairman. He is questioning 6 crypto exchanges on consumer protection. And really, he's pointing out what he perceives to be a problem, that of a lack of consumer protection insurance. Here's what I mean. He sent out 6 letters yesterday. Those letters went to Binance, Coinbase, Bitfinex, Gemini, Kraken, and KuCoin. In those letters, he's asking for information on what kind of protections are in place if something like FTX were to happen again. As he rightly points out, crypto exchanges offer customers no protections like FDIC, the Federal Deposit Insurance Corporation, or Securities Investor Protection Corporation. He said, quote, if these protections had been in place before the failure of FTX, far fewer retail investors would be facing precipitous financial harm today. Which, how do you folks feel about this? Because it sounds like he might be pushing for something like an FDIC for crypto. He tweeted out, quote, customers who entrusted their assets to firms like FTX are discovering they have no protections when those companies go bust. As Congress considers much-needed regulations for the crypto industry, I am laser-focused on ensuring real protections for customers. And so, in his letter, Wyden has asked these exchanges to answer questions on things like subsidiary companies, safeguarding customer funds, and protections against market manipulation. He wants those answers by December 12th. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. We'll see you tomorrow night.